Recession fear sparked a global stock sell-off. I'm Lisa Bernhard with Reuters, and joining me today is Kevin Nicholson of Riverfront Investment Group. Kevin, we saw Wall Street's main indexes plunge this morning. We've paired some of those losses amid a global sell-off among equities. And it comes off of some weak jobs data that we got last week, along with some manufacturing data. But tell me, do you think that the investor reaction was kind of overheated today, that they really overreacted? And do you think that the economy will tip into a recession?
I do believe that the market's reaction today has been over exaggerated and overdone. And the reason for that is that the Fed has stated that they're data dependent. We know that they have a bias towards cutting in September. They left that door open last week. However, I think right now the market is pricing in 5 rate cuts through the end of the year. And I think that that's exorbitant because you're basing this off of one data point. And we still have several more CPI prints to come, as well as an additional non-farm payroll.
So at this point, does that mean that you are not seeing a recession coming for the U.S. economy?
At this point, I don't think that we are in a recession. I think that we have definitely had some parts of our economy that are starting to slow down, and that is causing some angst.
Markets are now pricing in a 50 basis point rate cut for the Fed in September. Prior to that, it was 25 basis point cut. What do you think? Do you think it's 50 now?
Well, right now, I think that it's definitely going to be 25. And depending on how the data comes in between now and that September meeting, like I said, they have one other non-farm payroll number to come out, as well as 2 more CPI prints. So if those prints come out negative, I think that you could possibly see a bigger cut in September. But we also have to focus in on the fact that the Fed now is looking at this in a more balanced view. They're looking at employment as well as inflation. And before, they were just focused on inflation. So we'll have to wait and see what those prints lead. But right now, I'm thinking that it's still going to be 25, and we'll see where it goes from there.
So this isn't actually just a stock sell-off here in the U.S. It's kind of an everything sell-off, right? I mean, we're seeing metals down, we're seeing commodities down, oil down, Bitcoin down. Why aren't we seeing sort of more of a flight to safe havens like gold?
So I think that one of the things that is at play here is that before, people ran into gold because gold is an inflation hedge. But what we have gotten over the last couple of days have been more of a deflationary scare and a slowdown. So if we are headed into a deflationary type environment, then gold would not be appropriate. So that's why you're seeing gold go down with the market, but it's not going down to the same degree as the rest of the market.
Bond yields are down today to about 3.8% or so. What do you recommend in terms of bond investments?
From a bond standpoint, I think that investors at this point just need to stay put with their current holdings in the bond market, especially if they own treasuries. From a corporate standpoint, we still like the spread product because we think ultimately companies are in a good place credit-wise. So it's not saying that they are in desperate need of capital. So we still say recommend being invested in the 3 to 7 year part of the curve.
Where do you see the S&P 500 ultimately at the end of the year?
We still think that the S&P can get back up to its recent highs. And maybe a little bit higher, just once things shake out here. We are at a point, though, where we are seeing the market, test some of these theories and these investment theses that have been out there, where mega cap tech has led the way. And recently there has been the rotation into value. We think that this pullback is healthy for the markets, and ultimately that will allow for a more broader run up in the markets down the road.